This week, it wasn't just another blip. It was the week everything changed. Markets just took their hardest hit in months, and the dominoes are only beginning to fall. In a world of noise, you need signal. Welcome to Weekly Market Update, where two cutting-edge generative AIs, trained by a former senior portfolio manager, break down what actually matters. Why did the Fed freeze while the job market cracked? Is China already slowing too fast? And is Japan really about to hike into this chaos? If you're not listening, you're already behind. Don't miss the full breakdown. Watch or listen now, before the next shock hits.
Well, this past week, as August kicked off, the market certainly didn't ease in gently.
No, not at all. They started firmly on the defensive, you could say.
Absolutely. Investor confidence, it seems, took a real knock, primarily from, well, a pretty potent trifecta: renewed trade tensions, some surprisingly weak job data, and just a mixed bag of economic signals, really.
And even what looked like a generally positive earnings season couldn't completely fend off those forces.
So our mission today is clear. We're diving deep. We want to give you a proper understanding of exactly what went down across global markets this week, region by region.
We'll break down the key shifts, yeah.
Exactly. And highlight what's coming up right away, and crucially pinpoint those risks you really need to have on your radar.
And it's important context because this past week wasn't just, another week of numbers. It really felt like a significant shift in market sentiment. The Federal Reserve stayed on hold, sure, but you've got these emerging cracks in the labor market, plus that sticky inflation. It's creating a really complicated policy picture now.
Complicated is the word. And it affects everything, doesn't it?
Pretty much everything, yeah. Every corner of the global economy.
Okay, let's unpack this then. Starting here at home, the U.S. markets. I mean, if you were watching, U.S. stocks took their biggest hit in months.
It was quite the drop.
Yeah, S&P 500 down 2.36%, NASDAQ off 2.17%, the Dow Jones fell 2.92%, and even small caps, the Russell 2000, led the way down, dropping, 4.17%?
A significant fall for the Russell, definitely.
So what was it? What really blindsided the market this week? Was it one thing or just a combination?
I'd say it was really a 1-2 punch. Caught investors completely off guard. First, you had the sudden return of, let's call it, tariff turmoil.
Right, the executive order.
Exactly. President Trump reigniting trade anxiety with that new order, imposing tariffs on most U.S. trading partners. That kicks in August 7th.
And those partial deals didn't fully calm things down.
Well, they helped a bit. Deals with the EU and South Korea eased some pressure, sure, but this deep uncertainty about what's next just came flooding back. Lingering doubts.
Okay, so that's punch one and punch two.
Punch two was the labor data, a major labor market surprise. The July jobs report adding only 73,000 jobs, that was far, far below expectations.
Way below.
But here's the real kicker. The revisions. Huge downward revisions to May and June numbers.
So it wasn't just July being weak.
Precisely. It painted this picture of a labor market that had actually been much softer than we thought for months. That really shifted the perception.
Okay, so not just a blip, but a trend. How does that kind of data then feed into what the Federal Reserve is thinking, especially with inflation still, hanging around?
That's the absolute crux of it. The Fed, like you said, held rates steady again, 5th meeting in a row.
Yeah.
But internally, the debate's heating up.
The
Exactly. 2 members actually dissented, pushing for an immediate rate cut, which is tricky timing because June inflation came in at 2.8% year over year. That complicates things if you want rate relief.
Right. Can't cut easily if inflation's still up there.
But, and this is key, after that jobs miss on Friday, the market calculus just flipped. Futures markets swung right back to pricing in a September rate cut. A total reversal from just a few days before.
Wow. So the market's betting the Fed will have to act despite the inflation.
That seems to be the bet now, yes. And then earnings. It really was a mixed bag. Overall, pretty solid, actually. 66% of the S&P 500 reporting earnings growth, about 10.3%.
So big tech names did well.
Oh, yeah. Microsoft, Meta, they beat expectations. But the counterpoint, and this is important, came from companies like Ford, issuing these stark tariff warnings, really highlighting the cost pressures hitting the actual economy.
And speaking of market reactions, perhaps the clearest signal of fear was the VIX, the volatility index. What happened there?
The VIX jumped a staggering 37% for the week.
37%.
Yeah. And that's not just a number, right? That's the market's gut feeling. It's a clear signal of rising uncertainty about growth, inflation, policy, basically everything.
So deep anxiety is bubbling up.
Absolutely. The big takeaway from the U.S. this week, The soft jobs report and those trade tensions completely flipped the script on what was looking like a decent earnings season. Markets are now super reactive to bad news, especially the Fed kind of in wait-and-see mode. The shock absorbers just aren't there right now.
A hypersensitive market then.
Oh.
Okay, so that's the U.S. picture. But these things, these global pressures, they don't stop at the border, do they?
Yeah.
How did Europe cope with these transatlantic waves?
Europe definitely felt the pressure, too. Stocks fell there as well. There was quite a bit of skepticism about that new US-EU trade framework, the details being vague.
And signs of weakness in Germany.
Yeah, signs of stalled momentum in Germany certainly didn't help. The COXX Europe 600 index was down 2.57%. Germany's DAX fell 3.27%. France's CAC 40 shed 3.68%.
But the UK was a bit different.
Interestingly, yes. The FTSE 100 in London had a much smaller decline, comparatively.
Okay, let's dig into that EU-US trade thing first. Was it seen as a good deal for Europe or a letdown?
Honestly, a bit of both. On the plus side, tariffs were lower than some feared on certain goods. That was a relief. But crucial details are still fuzzy, unresolved, and that 50% tariff on steel and aluminum, that stays. So it definitely added to concerns that sort of protectionist shadow is still hanging there.
And the broader European economy. How's that looking?
Well, Eurozone GDP grew just 0.1% in Q2. Okay, that technically beat expectations, but it's way down from Q1. Suggests momentum loss.
Yeah, inflation.
Headline inflation held at 2.0%, but core inflation, which strips out volatile stuff, is still sticky at 2.3%.
But the job market's holding up.
That's the silver lining, yeah. Unemployment stayed at 6.2%, a record low, shows some underlying resilience. And economic sentiment actually ticked up in July, helped by services and retail confidence.
So it's this weird mix. Solid jobs, okay sentiment, but stagnant growth and sticky inflation. What's the main challenge there?
The challenge, the really fascinating thing here, is that Europe is walking this incredibly precarious line. You've got stagnant growth, but inflation is too high for the ECB, the European Central Bank, to just cut rates easily.
Their hands are tied?
Pretty much. Their room to maneuver is limited. And meanwhile, you've still got these external trade headwinds blowing from the US, from China. It's a tough spot with very little margin for error.
Okay, so continental Europe on a tightrope. But you mentioned the UK showing a bit more resilience, the FTSE 100 down less. What explains that?
Yeah, the UK market definitely underperformed less than its neighbors. FTSE 100 down just 0.57%. Part of that was a weaker pound sterling.
Helps the big exporters.
Exactly. Helps those large cap multinationals earning money overseas. But also, there were some genuinely surprising positive signs from the housing market.
Really? Housing, tell us more. That feels like a change of pace.
It does. The nationwide house price index actually bounced back 0.6% in July after dipping in June. And mortgage approvals, they beat expectations too. It hints at maybe some renewed buyer interest.
A stabilization, maybe.
Potentially. A potential stabilization, maybe even a little recovery in a sector that's been under pressure. On trade, the UK is still talking with the US, but no formal deal done yet. But yeah, that weaker pound helped cushion the blow for the big FTSE companies.
So the takeaway for the UK is?
The takeaway is that while the domestic picture is showing some, pockets of strength, the UK's huge exposure to global trade means it's still very vulnerable to what happens with global policy shifts and external demand.
Okay, let's pivot across the globe now to Asia. Japan first. Japanese stocks also fell. Nikkei 225 down 1.58%, 2PX down 0.11%. Tech weakness, trade jitters playing a role there too.
The usual suspects, yeah.
But the really big story out of Japan this week seemed to be the currency, right? The yen dropping to 4-month lows.
Absolutely. Those currency concerns are really building up. The yen fell past 150 to the US dollar.
150. That's a key level, isn't it?
It is, and it prompted official concern, noises from the finance ministry. It's becoming very clear that this kind of FX volatility is a major political and economic risk for Japan now. FX imports, exports, everything.
So how's the Bank of Japan playing this? Balancing the weak yen with their inflation goals?
Well, the BOJ held rates steady at 0.5%, but interestingly, they raised their inflation forecasts. And Governor Ueda sounded, well, a bit more confident. That definitely fueled speculation that maybe, just maybe, a rate hike could be coming later this year, perhaps to support the yen, tackle inflation.
Interesting. Any brighter spots in the Japanese data?
Actually, yes. Despite the market falls, domestic data was strong. Industrial production up 1.7% month-on-month, retail sales up 2.0% year-on-year, both better than expected.
So the domestic economy has some momentum.
It seems so, yeah. It hints at domestic strength despite those export pressures. So the takeaway for Japan, the economy is holding up better than maybe people feared, but the currency and global trade remain the absolute critical risks. They'll really shape what happens next.
Got it. Okay, let's round out our regional tour with China. Chinese markets also down. Shanghai Composite off 0.94%, CSI 300 down 1.75%, and Hong Kong's Hang Seng hit harder, down 3.47%.
A rough week for the Hang Seng, definitely.
And this seemed driven by weak PMI readings, those purchasing managers indexes, right? Sparking worries that the early year momentum is fading fast.
That's right. The PMI signaled a clear factory slump. Both the official and the private cakes and manufacturing PMIs dropped below 50.
Below 50 means contraction.
Exactly. Indicates contraction in manufacturing. And reports suggested flooding and extreme weather didn't help production either.
So this feeds into broader demand concerns.
It does. It points to a demand drag. You've got sluggish domestic consumption, plus the ongoing trade friction weighing on things. And remember that earlier export boost from front-loading, that seems to be waning now.
Which suggests growth could weaken further in the second half.
That's the concern, yes. So inevitably, we're back on stimulus watch for China.
Are they doing enough?
Well, fiscal support, government spending is ongoing, but investors, they're clearly waiting for something more. Stronger, more targeted measures from Beijing to really counter this slowdown.
So the pressure's building on Beijing.
Immense pressure. The key takeaway for China is stark. Growth tailwinds are fading, data's deteriorating. Beijing needs to do more, and probably soon, to prop up the economy. Market patience is definitely wearing thin there.
Okay, quite a week across the board then. So looking ahead, what does this all mean for next week? Let's turn our gaze to the key economic data, the policy decisions.
Yeah.
What should you be watching as we head into the week of August 4th to 8th?
All right, let's run through the calendar. In the U.S., Monday, August 4th, we get factory orders for June. Tuesday, keep an eye out for the trade balance, also June. And crucially, the ISM Services PMI for July. That gives us a fresh look at the big services sector.
And Thursday looks busy stateside.
Thursday, the 7th, is packed, yes. We get productivity and labor costs for Q2, wholesale inventories for June, consumer credit for June, and the weekly unemployment claims. Those claims will be watched very closely after this week's jobs report.
Any hints of further weakness there will be jumped on.
Absolutely. Elsewhere in Europe, Germany's trade balance for June is out Thursday. Over in the UK, Thursday is the big one, the Bank of England interest rate decision. Their statement will be key.
See how they balance housing strength with inflation.
Exactly. And finally, China, also on Thursday the 7th, gives us its July trade balance, plus exports and imports year over year. Those Chinese trade figures will be a really crucial test amid all this tariff tension.
Okay, lots to watch on the data front. Now, if we pull back slightly, connect this to the bigger picture. Beyond the immediate data points, what are, say, the 5 big themes, the overarching risks that you need to keep firmly on your radar as we move deeper into August?
Good question. Beyond the day-to-day, here are the top 5 strategic risks investors should be tracking right now. Number 1, U.S. recession fears are definitely gaining traction. If data keeps disappointing like it did this week, expect markets to price in a much higher chance of a slowdown.
Okay, recession risk escalating. Number 2.
Number 2, trade tensions escalating into a proper full-blown tariff war. That recent executive order really ramps up this risk. The fallout could spread fast.
Tariff war risk. Got it. 3.
Third, concern that China's post-stimulus slowdown really starts to undermine global industrial demand. That wouldn't just be an Asia problem. It'd hit the whole global economy.
China slowdown contagion.
4. Fourth, just expect rising volatility. Earnings season is wrapping up. The macro picture is messy. That VIX jump this week, probably just a preview. So, brace for more swings.
More volatility. And number 5.
And finally, number 5, central bank divergence. Specifically, if we see the Fed really moving one way, maybe cutting, while the Bank of Japan or the Bank of England are thinking about hiking or holding firm, that kind of split, it could really stir up currency markets, create instability, unexpected winners and losers.
That divergence risk.
Yeah.
Okay, a lot to monitor there. What an eventful start to August then. It's certainly proving hotter than expected for markets already.
It really is. And this raises a really important question for you to think about. If we do see more of that central bank divergence, say the Fed genuinely cuts in September while the Bank of Japan is seriously mulling a hike, what kinds of surprising, maybe even counterintuitive ripple effects could that create across currencies, across capital flows, things that maybe aren't immediately obvious right now?
Those second and third order effects. Definitely something to chew on as we navigate the weeks ahead. reflect on that complex interplay of forces.
Still watching? Then you're one of us, someone who actually wants to understand the markets. If this helped you think sharper, tap like, share the insight, and hit subscribe. Smarter markets need smarter minds. Let's grow this together. New AI-powered episodes drop every week. Imagine this format: AI-powered, sharp, fast, built around your industry, your firm, your market. For investors, leaders, or teams that move fast, we create custom podcasts designed to inform and impress. Curious? Contact us to build yours. Bespoke, bold, built by Flamingo's Research and Advisory.